How to survive a market crash. When the market crashes, fear spreads faster than the news itself. Headlines scream recession, portfolios turn red, and suddenly everyone becomes a financial expert. If you've ever checked your investments and felt that sinking feeling in your stomach, don't worry, you're not alone. But here's the truth. Market crashes aren't the end. They're part of the game. And the people who know how to survive and even grow during a crash are the ones who eventually come out wealthier. So let's talk about how to survive a market crash, mentally, financially, and strategically. 1. A market crash sounds terrifying, but it's simply a rapid drop in prices caused by panic and uncertainty. It doesn't mean the economy is permanently broken. It doesn't mean your investments are gone forever. Think of it like a massive sale. Prices temporarily fall because everyone's rushing to sell. And while most people run away, the smartest investors see opportunity. Every crash in history, from 1929 to 2008 to 2020, was followed by recovery. Always. The markets don't reward panic, they reward patience. The first step to surviving a crash is to understand it's temporary. 2. Control your emotions, not the market. When prices fall, your brain triggers the same fear response as physical danger. That's why investors sell low and buy high. Fear and greed run the show. But here's the rule. Emotion destroys wealth faster than a crash ever could. You can't control inflation, interest rates, or headlines, but you can control how you react. Before making any move, pause, step back, ask, is this a long-term problem or just short-term fear? Has my investment's true value actually changed? The answer is almost always no. The company, business, or fund you believed in yesterday is still the same today. It's just temporarily cheaper. Markets recover, but emotion-driven decisions can take years to fix. 3. Remember, crashes create millionaires. It sounds ironic, but it's true. Every great investor, Warren Buffett, Charlie Munger, Ray Dalio, made their biggest moves during downturns. Why? Because when everyone else is fearful, the market goes on sale. Buffett said it best. Be fearful when others are greedy, and greedy when others are fearful. During a crash, strong assets become undervalued. Solid companies with good earnings and low debt suddenly trade at discount prices. Those who keep calm and keep investing often make their biggest gains after the recovery. So, instead of asking, how much did I lose, ask, what opportunities can I find right now? 4. Protect what you have. Surviving a market crash doesn't mean ignoring reality. You need a defense plan, not panic, but preparation. Here's what helps. Emergency fund. Keep 3 to 6 months of living expenses in cash. It's your shield against forced selling. Diversification. Don't keep all your money in one asset class. Mix stocks, bonds, real estate, and even cash. Low debt. High debt makes downturns deadly. Pay off high-interest loans, so a crash doesn't take you down with it. A strong foundation lets you survive the storm and position yourself to take advantage of the recovery. 5. Keep investing even when it hurts. The hardest thing to do during a crash is often the smartest. Keep investing. If you stop investing every time the market drops, you'll always buy at the top and miss the rebound. That's why long-term investors use dollar-cost averaging, investing a fixed amount regularly no matter the market price. When prices fall, your money buys more shares. When prices rise, your earlier investments grow faster. Consistency beats timing. In the long run, staying invested through crashes almost always outperforms those who try to jump in and out of the market. 6. Focus on quality, not hype. Crashes reveal who's swimming naked. Speculative stocks, crypto fads, or get-rich-quick investments often collapse first. During tough times, quality matters most. Stick with assets that have real value. Profitable companies with strong fundamentals. Broad index funds like the S&P 500. Assets that produce income like dividends or rent. The flashy investments might double fast, but the solid ones survive. and survival is the first rule of wealth. 7. Tune out the noise. During a crash, the media thrives on fear. Every headline is designed to grab your attention, not to give you perspective. If you check your portfolio every hour, you'll panic. If you zoom out to the last 10 years, you'll see that even the worst crashes look like small dips in the bigger picture. Your mindset should shift from day trader to decade builder. Wealth isn't built by reacting to headlines. It's built by holding through history. 8. Reassess, don't retreat. A crash is also a wake-up call, a chance to review your portfolio and see if you've been overexposed to risk. Ask yourself, is my investment strategy built for the long run? Am I investing in things I actually understand? Does my plan still match my goals and risk tolerance? Adjust if needed. Rebalance your portfolio, add safer assets, or reduce speculative bets. But don't retreat entirely. You can't grow wealth from the sidelines. 9. Strengthen your skills and mindset. If the market is falling and you can't control it, focus on what you can control: your skills, income, and mindset. Every downturn is a reminder that wealth isn't just about investments, it's about adaptability. Learn new skills, increase your earning power, and build multiple income streams. Crashes test your portfolio, but they also test your discipline. And the people who come out stronger are the ones who use the storm as fuel to grow smarter. 10. Remember the big picture. No market goes up forever. No crash lasts forever. Every bear market in history has been followed by a bull market, always. The 2008 financial crisis, the dot-com bubble, the COVID crash, all painful, all temporary. If you zoom out far enough, the line always points up. The secret to surviving a crash isn't timing the bottom. It's having the faith and patience to ride through it. In the end, surviving a market crash isn't about predicting what happens next. It's about preparing yourself so it doesn't matter what happens next. Stay calm, stay consistent, keep learning, keep investing. Because history has shown one thing time and time again: those who stay strong during crashes